What the 2008 financial crisis taught us about dividend stability. The 2008 financial crisis was a seismic event that sent shockwaves through the global economy. Banks collapsed, stock markets plummeted, and millions lost their jobs and homes. For investors, the crisis was a brutal reminder of market volatility and the importance of resilience in investment strategies. One of the key lessons that emerged from this turbulent period was the significance of dividend stability. Companies that managed to maintain or grow their dividends during the crisis showcased not only financial strength but also provided a lifeline to income-focused investors. In this blog post, we will explore what the 2008 financial crisis taught us about dividend stability, how companies responded to economic stress, and what investors can learn to build robust dividend portfolios for the future. The role of dividends in investment portfolios. Dividends play a crucial role in investment portfolios, particularly for income-focused investors such as retirees. They offer a steady stream of income regardless of stock price volatility. During bear markets, dividends can also help cushion losses by providing a tangible return even when capital gains are scarce. However, dividends are not guaranteed. Companies may reduce or suspend dividends during economic downturns to preserve cash. The 2008 financial crisis provided numerous examples of companies that had to make difficult choices regarding dividend policies, demonstrating the need for investors to evaluate dividend stability critically. How the 2008 crisis impacted dividends. The financial crisis of 2008 led to widespread corporate earnings declines, liquidity challenges, and heightened economic uncertainty. Many companies, particularly in the financial sector, were forced to cut or eliminate dividends altogether. Notable examples include Bank of America. The bank slashed its quarterly dividend from 64 cents to 1 cent per share in 2008. General Electric, GEGE, traditionally a dividend stalwart, cut its dividend for the first time since the Great Depression, reducing the quarterly payout from 31 cents to 10 cents per share in 2009. Ford Motor Company. Ford suspended its dividend in 2006 and did not reinstate it until 2012, highlighting the prolonged impact of the crisis on certain industries. On the other hand, some companies managed to maintain or even grow their dividends through the crisis. Consumer staples and healthcare sectors, known for their stability, included companies like Procter & Gamble and Johnson & Johnson, which continued to reward shareholders despite economic turmoil. Key lessons on dividend stability. 1. The importance of strong balance sheets. One of the critical lessons from the crisis is that companies with strong balance sheets and ample cash reserves were better positioned to maintain dividends. Low debt levels and high liquidity allowed companies to weather the downturn without sacrificing shareholder returns. 2. Dividend payout ratios matter. A high dividend payout ratio, where a large proportion of earnings are paid as dividends, can signal risk. Companies with conservative payout ratios had more flexibility to sustain dividends even as earnings declined. 3. Cash flow is king. Earnings can fluctuate, but strong cash flow provides a more reliable indicator of a company's ability to support dividends. Companies with resilient cash flow from operations, particularly those in non-cyclical industries, demonstrated better dividend stability. 4. Sectoral differences in dividend stability. The crisis highlighted how certain sectors are more resilient than others. Defensive sectors like utilities, healthcare, and consumer staples fared better in maintaining dividends compared to cyclically sensitive sectors like financials and consumer discretionary. 5. Management's commitment to shareholders. Some companies have a long-standing commitment to maintaining or growing dividends, often referred to as dividend aristocrats. These firms often prioritize dividend stability as part of their corporate culture, providing a sense of reliability to investors. How to evaluate dividend stability today. In the wake of the 2008 crisis, investors have become more sophisticated in assessing dividend stability. Key metrics to consider include dividend payout ratio. Generally, a payout ratio below 60% is considered healthy. Free cash flow. FCF positive and consistent free cash flow is a strong indicator of dividend sustainability. Debt levels. Companies with manageable debt have more flexibility to continue dividends during downturns. Dividend history. A long track record of stable or growing dividends can signal a strong commitment to shareholders. Conclusion. The 2008 financial crisis underscored the importance of dividend stability for investors seeking reliable income. While no investment is without risk, Focusing on companies with strong balance sheets, manageable payout ratios, and consistent cash flow can enhance the resilience of a dividend portfolio. By learning from the past and applying these lessons to current market conditions, investors can better navigate economic uncertainty and build a portfolio that stands the test of time.